The questions I get a lot is, how do I know if I'm going to sell above an old high? How do I know it's not going to keep going higher? Well, that's the underlying market structure and the trust in the factors that I'm going to kind of like teach you tonight. In here, we're going to take a deep dive into that price action right there. All right, so we are looking inside that fair value gap on the daily chart. This was the high end of that fair value gap, and this was the low end of that fair value gap. The time frame on this chart, as you can see here, 1 hour, and I've outlined market structure in the idea of long-term high, long-term low, short-term high, short-term low, and in between those two swing points, there's an intermediate-term high and an intermediate-term low. When we look at price, I'm looking at, does the market have a reason to go up for buy-side liquidity or buy stops, or is it likely to go up to rebalance an imbalance, which is like a fair value gap? Or is it likely to go lower to sweep out short-term lows for sell-side liquidity or sell stops? Or is it likely to go down to rebalance an old imbalance or a fair value gap below market price? That's what I'm looking for. What is the current market narrative? What is it likely to be doing right now? Now, how do I arrive at that idea? Is it going to go higher or is it going to go lower? So right away, we know that price is traded up to the high end of that fair value gap. And again, this level here is that daily chart. Let me go back up one chart. That's this level here, okay? It's on this candle, that low. And the low of the fair value gap is this candle's high. Dropping down into the hourly chart, that's the high end of the fair value gap. This is the low end of the fair value gap. Again, on an hourly chart. So that way we have our bearings. So when the market traded up into and just above that fair value gap high, once it started to break down and go lower, it traded back down into this candlestick's high. So we're trading back inside this range, and we're range bound. Since I am expecting the daily chart to be the parent of this price structure, all minor lower time frame swings are going to be subordinate to it. And what does that mean? This now is a long-term high. I do not expect this high to be broken to the upside. Should it be broken to the upside, that means that my daily analysis, expecting this level here to hold price and to be a factor in the algorithm repricing and going lower at a later time, if it goes above that, then I'm probably wrong in my analysis. So therefore, I demand more information by studying more price action and sitting on my hands. Or if I have a trade on, it means that I have to admit that I'm wrong, and the stop out that may occur is just me managing risk. But as long as price remains below this high, my idea is this is a long-term high because it's framed on what? A higher time frame resistance level, if we want to talk in terms of retail ideas, so that way we can understand something in a simplistic manner. So this long-term high should remain intact. In other words, price should not go higher than that. We trade down to the discount level of the low end of that fair value gap, and it starts to find support, rallies back up, trades near the high, but does not take that out. Very important. Once it starts to break down and consolidate, in here, retail ideas will see a lot of trust in the idea that's potentially a bull flag. I love seeing those patterns because I like to fade them. So that's a false bull flag. And when we see price break down like this and then rally back up, every single time, and this is important, this is the part where you start writing down these details. Every single time price rebalances an imbalance, like we have this candle's low, this candle's high, we have that one single candle passing down like that. Once that rebalances by going up here, that swing high from this high, and this high, that's a swing high right there. I immediately label that in my mind, every rebalance of an old imbalance, that swing that's created at that moment, I immediately label that in my mind as an intermediate term high, or in this case, as we came back down and filled in this by dropping down here, that's an intermediate term low. What does that mean? What's the significance of that? Typically, what you'll see is intermediate term low has a higher short-term low to the right of it and a higher short-term low to the left of it. This intermediate term low forms by rebalancing, but it has a higher short-term high here, but then the market trades over here off of this short-term low. It rallies up, but it fails. It fails in here. We're going to anticipate that failure. Whereas if you're looking at this low, high, higher low, failed, higher high, higher low. So what's forming here? A pennant or a triangle pattern, right? How do you know which side's going to break out? The market has traded higher and then consolidated. We failed to go above this important high back here. That's a long-term high. Then we have an intermediate term high. Why? Why is this an intermediate term high? Because we have a short-term high here and a short-term high here. So between two short-term highs, the highest high between those, that's an intermediate term high. But the main takeaway for your notes so far is anytime a imbalance, like this big candle up, is rebalanced, that becomes an intermediate term low. Just as well on the opposite end, this down move here, that's a fair value gap. As soon as it rebalances there, that's what I classify as an intermediate term high. Now here's where we take a huge step forward. So when you hear people talk about market structure and they're looking for a higher high, higher high, higher high, and having successive lower lows behind them, and then you have a failed higher high, and then it breaks the swing low right before that failed higher high, they look at that as a change in trend. Not all the time. Many times that's a good buying opportunity for me because really that's just coming back down to a deep discount, and I'm going to buy those. So it's a little tricky if you don't understand the higher time frame, which is what those red levels are. That's higher time frame. The hierarchy in parent to child price swings, okay, so that way the subordination that the smaller time frame price swings adhere to from the higher time frame is directly linked to the order flow on those higher time frame charts. So in other words, what am I saying? The daily chart has the bulk of the volume that's coming into that marketplace. There isn't a lot of volume coming in on a 1 minute chart. That's not to change the importance or reduce the importance rather of a 1 minute chart within the proper context and market structure that's underway. So if we have a imbalance that's rebalanced and we have an intermediate term high, shouldn't an intermediate term high have a lower short-term high to the right of it and a lower short-term high to the left of it? Yes. An ideal scenario should be this high should be above both short-term highs, but it's not. So what is it doing? It's only rebalancing this. And where is it likely to go? Well, if you're thinking in terms of a pennant or a triangle pattern, it's indicating to me, as soon as this candle starts to go up like this candle and this candle. Why not this candle too? Well, this candle only has this low here. This candle is an up close, but this starts the last two up close candles right before this move down. This is important because we're going to look inside this shaded area and how we can use highly precise ideas within this order block. I'm anticipating this run up with these candles forming an order block. This movement here, these two green candles that are going up, I'm watching these as they form live with the expectation, because this imbalance has been rebalanced here, this swing high is an intermediate term high. I do not expect this high to be taken out. So I'm already forecasting and anticipating a failed price swing in here. Every time this green candles are forming, I'm looking at that as a bearish order block. So from the beginning at that candle's low, I'm looking in time on lower time frame charts. Lower than what? Well, this is a 1 hour chart. So what's the time frame below that? I dropped to a 15-minute time frame. Now, before I get any further, just know that the range between this long-term high and this long-term low, that range is going to be used for targeting purposes. And I'll get into that in a moment. But these up-close candles, from the hourly perspective, that's the range for my hourly order block. Inside that range, I can be hunting fair value gaps. Light bulb. I don't need to see the market trade down below the last highest up-close candle. I don't need that because I understand what I'm looking for inside market structure, actual market structure. What is it doing high to high, low to low within a higher time frame premise? Remember the premise was we were going to go up to this upper level here, rebalance, and then eventually trade lower down below sell side liquidity. In this fractal, I'm using this one here just to illustrate the idea. So in other words, up here, it's going to make a short pattern, something bearish to get short on, then work towards going down to that low. Before I zoom in, look closely. What do you see? Pause the video. I'm not pausing the video, ICT. And you can't make me. All right. Right in here, you can see a small little imbalance. This one single candle like that right there, that's the same thing that was occurring in this move here on the hourly chart that gets rebalanced there. Here, we have a smaller version of it. That is a fractal. That's something that repeats on a smaller or higher time frame that's similar in its formation. It won't be identical, but it's closely related to the general idea. If it trades back to this candle's high, that's your entry. That's aggressive, and I don't have a problem being aggressive if I know what I'm looking for. But there's also an imbalance in here, and it rebalances that right there. See that? Now, once we establish the market structure on that hourly chart, I'm not going down into the lower time frames below it and marking out all the swing highs and swing lows either. That's overkill. I just need to know what I'm looking for on the time frame I'm trading on. The logic is based on that daily chart that it's going up into this imbalance to go lower. The hourly chart frames my trade. It gives me what I'm looking for to start hunting entry techniques. Now, the 15-minute time frame, that's the bellwether. This is where it's going to give me the actual get in, get out. But I might not like the risk parameters that's required on this time frame. So I can go down into lower time frames. Should price go lower and break lower, I'm looking at that short-term low here and that intermediate-term low there. If we have a short-term low taken out and an intermediate term low taken out, or just an intermediate term low taken out, then we can go back to the previous long-term high, long-term low. Now, a long-term high and long-term low is generally going to be linked to a higher time frame daily chart. That might be a price range. It might be a high to a short-term low. In this case, I'm framing the idea and logic around that fair value gap that I outlined in front of all of you, saying it's likely to go up there, rebalance, and then go lower and take out that old daily low. There's lots of ways you can frame your trade, but you have to have something directly linked to that daily chart, because the daily chart, that's exactly what institutions are working off of. That's exactly what banks are working off of. That's where the money is. That's where your bias is going to be determined. That's going to be what makes or breaks your trend continuation, that daily chart. So the majority of your time and study should be on determining where that daily chart's going over the next day or two or a week. So if we have a break below an intermediate term low, then we have what? A significant break in market structure. This is something that's more significant just simply than going into a chart saying, okay, well, it took out a short-term low. There it is. See how much more detailed this is? What this tells me is then I can start using this range high and low and start getting projections down. I can get a measurement of measuring this high to this low and start replicating that going down. And it'll give me price targets. They're generic price targets. If you don't want to use that targeting method, this long-term low to intermediate term high, if price breaks below here, as it does here, you can simply take your Fibonacci, anchor it to the highest high, down to the lowest low, and this is what you would get here. Why am I using that? Why am I not using this here to here? Because this return back up, this is where all of this move starts right there. This is just the beginning of the framework. This is where the swing begins on the decline. Follow what I'm saying? I'll say it again. This high and this low, that's your framework. The retracement that fails, that starts the decline, begins here at that intermediate term high. So if you anchor your fib to the intermediate term high down to that low, which is a long-term low, the projection is negative 1.5 standard deviation, and there's your low. This is an aggressive entry for going short. Now, that hourly chart was showing those two candles going up. In the 15-minute time frame, it's obviously more candles. So in this up-close candle series of 1, 2, 3, 4, 5 candles, in that range, if I get a fair value gap form with a breakdown like this, notice I don't need a swing low broken. Notice that? On the model I'm teaching you, you have to look for what? The short-term low being broken. That's your market structure shift. Then you see price go up into that imbalance, and then you can go short, or vice versa when you're going bullish. If you understand market structure with this perception, looking at it from a higher time frame and anticipating a breakdown, but then starting to classify each imbalance and swing high and swing low, intermediate term highs and lows are formed at the rebalancing of an imbalance. If the intermediate term high is not higher than two short-term highs, that is telling you that the market is very weak, and the algorithm is tipping its hand to those people that are looking at it like this. Who would be looking at it like this? Smart money traders. They're looking at imbalance, rebalance, and liquidity. That is it. This is your aggressive entry. You don't need a swing low being broken because you have the idea based on market structure suggesting that this is exceedingly weak. If it's exceedingly weak, that means the next short-term high, how do I know it's going to be a short-term high? I don't know because I'm studying the up-close candles, because that's going to be an order block later on. Now, everybody else knows how to look at these candles after it goes below it and comes back up and bumps the bottom of that right there. So the bottom of that rectangle, that's the classic ICT bearish order block. The advanced interpretation of an order block would be using market structure like this, which is unconventional, but you start seeing the imbalances inside the order block when you're already expecting it to sell off. See, this intermediate term high, I already know that this rebalance here classifies this in my mind as an intermediate term high. That means it should not trade above that high. Just like this short-term high and this short-term high did not trade above this intermediate term high. Why is this an intermediate term high when it didn't even rebalance anything? Here's a long-term high. Here's a swing high over here and a swing high over here. See that? Long-term high, right? Intermediate term high, short-term high, short-term high, or if you want to use this one, I'm using this one, not classifying this one because this is energetic, it moves lower. You could have easily had a short-term high marker there, but I'm using this one because it has that run lower to rebalance. The intermediate term high has a lower short-term high to the left of it and a lower short-term high to the right of it. So intermediate term highs, there's two classifications. It is a short-term high that has a lower short-term high to the left of it and a lower short-term high to the right of it. Or, and this is the main one here, it trades back up to rebalance and imbalance. That immediately becomes an intermediate term high. Now, the usefulness of that is if we're bearish and it rebalances like this, the next short-term high should be lower than that intermediate term high. If it trades higher than that, then your trade idea is probably flawed. Don't force that trade. Again, wait for market structure to get back in sync with what you're expecting, something bearish. That's how you keep from blowing your account or forcing your will in the marketplace. Inside these candles as it's going up, I'm looking at lower time frame charts, and this is a 15-minute time frame. We see it break down. It doesn't take any short-term low out, but it's inside these up-close candles, which is an hourly order block of 2 candles each. Your stock could be right above that high. Classic low-risk, high confirmation short entry is the classic return back to an order block after it trade down below it. Here's your little gap. Trade into it. There's your short. Where's your stop? Above this candle's high. You can go down into the charts deeper with your 5, 4, 3, 2, and 1 narrowing down to a smallest time frame. You can see that the last 2 candles here, wait for the turn, inside the order block. These last 2 candles here with the gap, that low is exactly to the quarter point as that candle's high right there. Why am I pointing to that candle? Because the order block is one consecutive series of up-close candles. It's not the last candle before the down move. Order block theory is much more than just simply the last up-close candle before the down move or the last down-close candle before the up move. That's not it. This is it. You have the up-close candles together here with the imbalance inside of a larger order block within a bearish market structure because we have an intermediate term high here. Then this run up is going to fail to go back above this high. The imbalance here, it goes over a little bit. That's okay. But inside this range in here, more specifically, the order block, the hourly right here, that's where your fill would be, or aiming with your limit order. And the heat on the trade would be on this candle's movement there, but your stop would be above here. What I want you to think about is when you see these patterns for entry, the idea is this. When you see an imbalance get rebalanced, the high formed as it rebalances, that high should not be violated by price going higher than that if you're bearish. If you blend that with institutional order flow, what is institutional order flow? When you're bearish, all of your up-close candles should keep price from going higher than them. What does that mean? We have an imbalance here. The market trades up into the bullish candles that are on the 5-minute chart. We're on a 4-minute chart. That's that red level here. Let me go back up to say, you know, that's this one here. This is a down close candle right there. These are the last 2 up close candles before the displacement here and imbalance. The market trades back up into that right there. There's your bearish order block. It's aggressive, but if you know you're looking for, that's very, very fun to do that. On the 4-minute chart, there's that same return back to that 5-minute bearish order block. Watch what happens. Market breaks lower, so we have up close candle and up close candles. The market trades higher, yes. But does it overtake this up-close candle? No, it just trades back up into it a little bit, but doesn't go above it. That's important because if it doesn't overtake these up-close candles here or here, it doesn't even need to get to these because it hasn't even overcome this one. So it acts as real resistance. That's institutional order flow. Your market, when it breaks again from the consolidation in here, all of these up-close candles never get reached into again here at all. But notice what we've got over here. We have up-close candles. The market leaves it. Then it comes right back up. Does it overtake these up-close candles? No. So it's going to remain heavy. So in short, I've taught you tonight to look at the markets from a market structure perspective by breaking down the price swings, labeling them, specifically an imbalance that's rebalanced. That intermediate term high or low should not be violated. That's a key high or a key low. That sets the stage for a market move that should unfold and deliver to a higher time frame objective. If you combine that logic with market structure and the imbalance rebalance becomes intermediate term highs and lows, those key highs and lows with them not being violated, if they are violated, that means your idea is wrong. And you cancel the idea and you don't try to go in and force it again and overtrade and blow your account. While the market is moving in your favor, you're going to continue to trust that move and hold on to your trade because if you're bearish, up-close candles should keep price below it or them if it's multiple up-close candles. They're speed bumps. They may come back up and touch them and act as a what? Bearish order block. but you do not want to see them traded above if you're bearish. And vice versa, if you're bullish, predominantly there's going to be more up close candles when it's bullish. But down close candles should support price. If it trades back down to them, it's going to act as a support structure for an order block. If that intermediate term high or low is broken after your trade idea becomes possible, if that intermediate term high is broken and you're bearish, then you got to move to the sidelines and don't go in again. Wait for more setups in the future. It may be in the same trading session, or it may be in the same trading day, or it may require you to trade in the following week. You just can't force it. I taught you institutional order flow, which is, again, we're bullish and we're expecting a price swing higher. Generally, there is not a lot of down close candles in that price swing higher, but those down close candles should support price should it trade back down into them and not see them overlapped, in other words, going down below it. If it does, it's only permissible if there's a short-term low in close proximity to it, and it's then likely to just go down and take out some sell stops if it's bullish and then reaccumulate and go higher. If there is no swing low, there would be no swing low with sell side below it, so there's nothing to concern yourself with. Just look for down close candles to support price higher. So in other words, price swings that are bullish, down close candles are your support. In price swings that are bearish, up close candles are your resistance.